Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 20th day of November, 2018. And I do want to remind you, I publish a newsletter that focuses primarily on gold and silver, precious metals, mining stocks, not exclusively, but mostly, on companies that some of which are talked about on this show, companies that I believe have the tremendous potential to create a lot of, to find and discover a lot of wealth in the ground. Basic wealth-creating industry is what mining is. We need more of it in the United States, and a lot of the companies that I follow do have projects in the U.S. But I have a lot of excitement for in the future, and I think Michael Oliver, who will be with us in a minute or two, may provide some ammunition in that regard. Chen Lin, I like to always remind you of his newsletter, chenpicks.com. Chenpicks.com is where you need to go to sign up for what is Chen buying, what is Chen selling. And Michael Oliver's MSA, olivermsa.com, olivermsa.com for his structural momentum and structural analysis, and he does provide a lower cost, $299 a year subscription for people interested primarily in the precious metals and the precious metal stocks. And thank you to all of you for listening to this show, making it one of the more popular shows in the Voice America Business Channel. We also like to hear from you. Send your questions, comments, criticisms, or comments of any kind to questionsfortaylor@gmail.com. Questions, the number 4, taylor@gmail.com. I want to thank our sponsors, because without them we would not have a show. Novo Resources, Sandstorm Gold, Triumph Gold, Gold Mining, Inc., Uranium Energy, and Klondike Gold Corp. Are the sponsors for this week's show. I would like to mention a friend of mine, David Jensen, who keeps track of the metals markets very closely, pointed out to me that palladium is in a very severe backwardation. There does seem to be a shortage of palladium on the markets. Russia and South Africa are the primary producers. They produce 80% of all the palladium. There does seem to be a shortage. The price has spiked. It's come back a bit today, but it's a very strong price. And I did an interview with David talking about the backwardation in palladium, which you can listen to if you go to jtaylormedia.com, jtaylormedia.com. Click on the podcast page, and you can hear of what David has to say there. Also, I am writing a letter, actually adding a company, North American palladium producer, in my newsletter this week that I am very excited about. And if you'd like to learn more about that, you're certainly free to subscribe to my newsletter. Now, today's show I've titled, Why Are So Few Americans Able to Get Ahead? Charles Hugh Smith, John Anderson, and Michael Oliver are the guests for this week's show. Despite the rah-rah about the ownership society and the best economy ever, according to Donald Trump anyway, at least the sobering reality is that very few Americans are able to get ahead in terms of building real financial security. Why, if the economy is so good, as President Trump suggests, and virtually all his supporters on Fox News tell us it is, why then are there so many young people, such a large percentage of our population of young people, living in their parents' basements? Well, we'll explore some of the reasons why Americans are no longer living the dream, the American dream that has been so much a part of our society in the past. And Charles Hugh Smith should have some insights into that. In fact, we're basing our discussion in part on a paper that he wrote on that very topic. One junior exploration company that I have very high hopes for, and one of my personal top holdings, is Triumph Gold. This company's district-scale project already has a gold equivalent resource north of 4 million ounces and 3 different deposits. However, it has recently discovered what looks like a very large gold-copper porphyry deposit that has many of the world's largest base metal miners very interested in the project. And the company's largest shareholder is Gold Corp, that owns just a whisker under 20% of the stock. In just a few minutes after a first commercial break, I'll be speaking with John Anderson, the executive chairman of Triumph, for an update on that company's progress. They've had a lot of success last year in their drill program, and we want to find out what he's planning for 2019. But right now, I'm pleased to tell you that I have Michael Oliver with me once again to help us sort out the markets, and boy, they're looking increasingly volatile. Thanks for joining me, Michael.
Good to be back, Jay.
Always good to have you. Now, Michael, you're really focused on, and I think most people are really focused on, the equity markets in the U.S., but I think you have some insights into why the equity markets are so important and how they might impact other markets, a lot of other markets. Could you comment on that today for us?
Yeah, I think they all feed back into each other to some in varying degrees at different times for different reasons. So the asset categories, debt markets, foreign exchange, stocks, and commodities. And we thought 2 years ago that there was a tectonic plate shift beginning. And I think arguably it was. Gold bottomed. Yes, no, it has not taken off, but it is clearly well above its lows, and it's lived above its lows, and built what we think is the upper end of a base prior to a major upside move. Okay, that's step one. Commodities bottomed. Some of them took off real big, oil and copper, and are now paying dues back on the downside, but still way above their 2016 lows. Even the Bloomberg Commodity Index, which is weighed down by food commodities, which we think is probably the best place to be in terms of value and future percent gain, is still well off its bare lows. Okay, so that category shifted, has begun the shift. Dollar shifted. We got bearish. It hit 103.50 dollar index back in early 2017, and we got bearish in May of 17 when it came down to 99, and it's still well below there. It's having a big rally, but it's broken in our view. Then you go to the debt markets, the bond markets. They peaked in 2016 in price, low yields, mid-2016, and broke down hard in price. T-bonds right now are 30 some odd points below their highs, and they're having a counter-trend rally right now, we think is associated with stock weakness, and probably could see more of that too. Now, and then the stock market was the dumb one. And it quite often is. It's the last one to finally move and say, oh, my goodness, things are changing. And so sometimes it behaves in a panic way when it realizes the new reality. And I think that's what's going on here. I don't think it has anything to do with earnings or temporary things. I think it has to do with decades of central bank manipulation of asset prices, particularly over the last 6-7 years, since at least 2011 especially, where all the major developed market economies, central banks, distorted the cost of money and the quantity of money greatly. And they did it for a long period of time, and therefore they built in major investment distortions by private institutions, corporations, and by governments based on the assumption of what's the cost of money.
Yeah.
Okay? And you make a bad bet based on that information, but it's been over such a long period of time, not their normal boom bust where they might distort something for a year or so by too low rates, for example, that stimulated the housing bubble. But it wasn't over 5 and 6, 7 years. This is the biggest one of all. So they've created a time bomb. Now the stocks are finally starting to acknowledge, I think, not what's on the temporary horizon, not the good economy stuff, but the deeper problems, the debt problems, especially. And that has, that's not changing. Anybody that looks at, the government debt trajectory, that's not changing, especially with Trump's military spending,
Sure.
Okay. So anyway, I think the stock market has now got the message, and we've declared it a bear, despite the fact that you're not the, quote, orthodox 20% off the high before it's a bear type thing. We declared it a bear in early October, and we hold with that view. There could be nice, fitful rallies, but it's a bear, and we think it's going a lot lower. The issue is the speed. Can we crash, or are we going to do a 2000, 2002 type bear, or 2007, 2009 type bear, which was a layered decline, sometimes sharp, but still much zigzags in the move? Or are we going to have something more efficient? And frankly, we're a bit mixed on that. It could be more efficient, but there's one interesting thing that could happen here. If the stocks get a little shockingly weak here and take out the February low, which they've yet to do, we're 2,600 plus. If you get down to below 2,550, you're challenging the lows of the year. You take those out, that's going to be a big headline. And I think it's going to upset Trump to some extent. And we know he's a deal maker, and he had something going for him because early in this process of the deal tariff war with China, Chinese stock market was quite weak. Ours was not. And so he said, I got them over the barrel, and we're in good shape. Now suddenly his market is collapsing, and their market is firming. It's fact, we're at points on the Shanghai Composite that if they go a little bit higher than yesterday's high on a weekly close, we're frankly bullish for a couple months. But he's now got a problem with his market, and a lot of businessmen aren't real happy. In fact, a lot of his friends aren't real happy with this tariff thing. They open letters in the Wall Street Journal. Okay, stock market can have wave effects for a lot of other markets, especially if he does a trade deal in the dark with the Chinese that makes them look good, makes him look good. Soybeans could take off, been a primary victim of this situation. Grains could be benefited largely by that. I also think it would help, it would cause the bond, certainly Powell will also be affected by this in terms of more rate hikes. And if they let off on the rate hike bit, they back up just a bit or indicate pause, and I think they've already begun to hint that, if you subtly read their words. That will affect the dollar, and the dollar has had a counter-trend rally, largely due to the fact that we've had rate rises and Europe hasn't, and Japan hasn't. If that changes, or the view is that the rate situation could change now because the Fed's going to back off and Trump's, et cetera, then the stock market events could have waves in other markets because it causes Trump to do a deal that could help soybeans and et cetera, et cetera. But right now, I think the main thing to watch is the S&P because I think if you go just a bit lower than today's lows, they're going to take it off the page. And by not that, I don't mean a crash, but take out the Fed lows decisively, probably go down to around 2,400 area, which is, about 8-9% below where we are right now, and do it quickly. And that could cause a lot of wave effects and unsettled money moving, specifically more into commodities, but especially gold and silver and the miners.
All right, Michael, we're just about out of time. One thing I want to ask you before we say goodbye today is equity markets tank. Are gold shares going to get taken down with them? No,
they've defied that so far. They made a low in August. Stocks made a high in August. The GDX has not gone below that low. And in fact, the GDX is rat hairs away from propelling itself higher in another shoot. It had a good shot up off the August lows, and it's gone into congestion. I think if you go about 30 cents above today's high on a weekly close, you're going to tack on another several dollars on the GDX and begin the upside.
All right. So rat hairs are pretty small, I guess. So what you're saying is they're pretty close.
Rat hairs like 30 cents, 0.30. Anyway.
Okay, very good. Well, Michael, thank you so much. A very interesting, colorful commentary today about the interaction of geopolitics and markets, but certainly very fascinating, very interesting, and all makes a certain amount of sense to me, that's for sure. Folks, check out Michael's work, olivermsa.com, olivermsa.com. Thank you so much, Michael. We'll look forward to talking to you next week.